Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
All right, $2.08. That's where CYN Inc., ticker CYN, closed today, Tuesday, January 27th, 2026. It finished the session down, what, 6.73%. But I mean, looking at that closing number is like reading the final score of a game without watching any of the highlights. You just miss the actual violence of the match. We saw a pre-market spike of nearly 27% this morning. On news that, well, objectively should have sent this stock flying, we instead witnessed a textbook pop and drop. The stock surrendered absolutely every cent of those gains on heavy volume.
In that specific price action, that pop and drop, it tells you everything you need to know about the structural integrity of this equity right now. We are looking at a company sitting at a violent intersection. On one side, you have your case, the operational narrative. They just reported a tripling of orders for their drive mod tuggers. Sounds great on a press release, you know? But on the other side, the side the market is actually trading on, you have a capital structure that is in critical condition. We are staring down the barrel of a massive 1-for-150 reverse stock split scheduled for February 18th.
It is a critical junction, absolutely. But the argument I am making today is that the market is missing the forest for the trees. The operational metrics, specifically that tripling of orders year over year and the expansion with major partners like Pepsi, they signal a legitimate turnaround. This is the inflection point where a science project finally becomes commercial scaling. The price action today was just fear, not fundamentals.
And I am going to argue that the financial engineering required to keep this listing alive, specifically the reverse splits and the dilution history, along with the hostile market microstructure, renders the equity completely uninvestable. It doesn't matter how efficient the robot is if the stock is caught in a death spiral. You can have the best technology in Silicon Valley, but if you treat your shareholders like an ATM, the equity value, it goes to zero.
Well, let's get into the specifics of why today's price action was so disconnected from the fundamental reality. The headline news today, January 27th, is that CYN Inc's orders for the drive mod tugger tripled in 2025 compared to 2024. Now, for a company that has been stuck in what we in the industry call pilot purgatory for a while, this is the signal we have been waiting for. This isn't just kicking tires anymore. CEO Leo Tao confirmed these aren't just singular test units. This is volume growth.
It is growth in orders, yes. I'm not disputing the press release or the math. But let's be precise about the market psychology here. When that news hit the tape, the stock ripped 27% in the pre-market. And then, selling into strength. Relentless selling. This is a behavior characteristic of a trapped shareholder base. You have investors who bought at $5, $10, or even higher, adjusted for previous splits, who have been holding heavy bags. They see a liquidity event, a moment of volume, and they use it to exit. They're not looking at the long-term thesis. They're looking for the door. That psychological overhead is a ceiling the stock just cannot break through.
But that's technical pressure, though. That is about the stock chart and the psychology of past investors, not the future of the company. You have to look at the quality of the validation we are seeing. Go back to last month, December 16th, 2025. G&J Pepsi, the largest independent Pepsi bottler in the U.S., placed a follow-on order. In the world of industrial robotics, selling the first unit is actually the easy part. Companies have R&D budgets for trials. They'll buy one of anything just to see if it works.
Sure, corporate curiosity is a real thing.
Exactly. But the second sale, the follow-on, that is the holy grail. It means the return on investment is real. It means the software works in a messy, chaotic real-world facility, not just some pristine lab. That validation from a blue-chip customer proves the land and expand strategy is actually working. They tried it, they liked it, they bought more. That is the definition of product market fit.
Okay, product market fit. I'll give you that the robots physically function, but I dispute that the business model functions for the common shareholder. You mentioned the Pepsi order, and yet look at the revenue recognition. In the third quarter of 2025, they recognized roughly $69,970 in revenue. $69,000. Against an annualized burn rate of roughly $32 to $35 million. That is a terrifying ratio. There's a massive lag between bookings, which is just a signature on a page, and revenue recognition, which is cash in the bank. And while we wait for that revenue to actually show up, the share count is being obliterated. We are weeks away from a 1 for 150 reverse split. And remember, that follows a 1 for 100 split from July 2024. The dilution is it's relentless.
The revenue lag is standard in industrial accounting. You know that, you book the order, you manufacture, you deploy, and then you recognize revenue later. It's lumpy. The market is pricing this as if they are going bankrupt tomorrow, ignoring the fact that they just proved the commercial demand is tripling. The revenue will catch up to the bookings. But I want to pivot to your point about the selling pressure, because I think there is something deeper going on than just frustrated retail investors selling.
You're talking about the market microstructure.
Exactly. The plumbing of the trade.
Let's dig into that because I think that is the most disturbing part of the science story. I was looking at the order flow data for today. Over 52% of the trading volume for CYN took place in dark pools.
Which is high even for a small cap.
It is exceptionally high. For our listeners who might not track market structure, dark pools are private exchanges. When a trade happens on the NASDAQ, it's a lit market. Everyone sees the price and the volume immediately. Dark pools are off exchange. When you have over half your volume happening there, price discovery is effectively broken. Retail investors see a price on their screen, but the real institutional flow, or the wholesaler internalization, is happening privately. This acts as a wet blanket. It dampens volatility when the stock tries to rally because the buying pressure isn't hitting the public order book in the same way. It just suffocates the momentum.
I agree it's an obstacle. It makes the climb steeper for sure, but you can't just blame the dark pools for everything. If the demand for the shares was genuine, if institutions really wanted in, they would break through that wall. Volume solves all ills eventually.
But is there genuine demand? Look at the short-term interest. We are sitting at roughly 11.33% of the float sold short. The days to cover ratio is over 4. Now, technically, that is a squeeze setup. If buyers rushed in, the shorts would have to cover, driving the price up. But the fact that the stock faded so hard on today's good news tells me the short sellers are incredibly confident. They are not scared of the order book. They are well capitalized, and they're betting that the dilution machine will just keep printing shares, allowing them to cover cheaper later. They are playing the long game against the company's capital structure.
I think you are misinterpreting the confidence of the short sellers as wisdom. They are playing a dangerous game because they are ignoring the insider alignment. Look at the ownership table. CEO Lior Tal holds somewhere between, 6 and 9% of the company? Unlike so many microcap scenarios, pump and dumps where management dumps shares the moment the lockup expires, we haven't seen aggressive insider selling here. The dilution is corporate issuance to keep the lights on, yes, but it's not insiders cashing out to buy yachts. Management is in the boat with the shareholders. They only win if the stock goes up.
But is it going up? I mean, being the captain of a sinking ship is noble, certainly, but it doesn't stop the ship from sinking. Insider alignment is great, but cash flow is better.
It's not sinking, it's refitting. And this brings me to the core misunderstanding of their market position. We need to differentiate between greenfield and brownfield automation. The market looks at a company like Symbotic, ticker SYM. That's a $36 billion company trading at 16 times sales. The market says that's the winner. But do you know what Symbotic actually does?
They build massive automated warehouses.
Exactly. They do greenfield projects. They go in, gut the building, and rebuild an entire warehouse from scratch with a massive metal grid. It's like something out of the Matrix. It costs hundreds of millions of dollars and takes years to complete.
And it works perfectly. That's why Walmart uses them. It's a proven, albeit expensive solution.
It works for Walmart because they have billions to spend and years to wait. But what about the tens of thousands of older warehouses? I'm talking about the ones built in the 1980s or 90s with cracked concrete floors, narrow aisles, support pillars in weird spots, and bad lighting. They can't afford a Symbotic grid. They can't shut down for 2 years to rebuild. That is the brownfield market. That is CYN's moat. Their technology is a retrofit. They slap LiDAR and sensors on a standard Mutrek tugger, a vehicle that already exists, and suddenly it's autonomous. They don't need to rebuild the building. The total addressable market for retrofitting existing, messy facilities is orders of magnitude larger than the market for building shiny new ones.
That sounds compelling in a pitch deck. We are the solution for the messy real world. But if we are looking for a play on industrial robotics, why take the risk on a company trading at 12.5 times trailing sales with a distressed balance sheet? Look at Oceaneering International, ticker OII. They trade at 1.1 times sales. They are profitable. They have a massive mobile robotics division doing exactly this kind of industrial work. If I want exposure to this theme, why wouldn't I buy the company that makes money today, rather than the one hoping to make money in 2027?
Because Oceaneering is a diversified industrial conglomerate. It's safe, sure, but it's not a pure play. You're buying subsea oil and gas exposure, offshore energy services. You're buying a lot of legacy baggage with that robotics unit. With CYN, you are buying a focused software stack. And, speaking of stack, we have to mention the NVIDIA partnership. They are using NVIDIA's Isaac Sim to create digital twins. This isn't just marketing fluff.
Digital twins is a buzzword we hear a lot. What does it actually mean for their bottom line?
It means they can map a customer's warehouse, digitally create a twin, and train the robots in a virtual simulation before the robot even arrives on site. They can run thousands of scenarios. What if a forklift cuts it off? What if a pallet falls? What if a worker steps out? By the time the physical robot arrives, it already knows the facility. This cuts deployment time drastically, which reduces the cost of customer acquisition. And just last month, December 23rd, they announced the expansion into agriculture with Chandler Automation. They are diversifying verticals, not just stuck in warehouses. They are proving the software is platform agnostic.
The NVIDIA partnership is a feather in the cap, I admit. It lends credibility. But let's zoom out to the macro sentiment, because stocks don't trade in a vacuum. I was looking at the prediction markets on Polymarket this morning. The smart money, betting on Polymarket, is assigning a greater than 60% probability to Tesla achieving unsupervised full self-driving by June 2026.
Exactly. The macro tailwind is huge. Autonomous driving is the zeitgeist of the decade. The world is ready for this.
No, see, that's my point. It's a divergence. There's massive optimism for AV technology right now. A rising tide is lifting Tesla. It's lifting NVIDIA. It's lifting Waymo. But CYN is at 52-week lows. It traded as high as $73.35 in the last year on an adjusted basis, and now it's at $2. The rising tide is not lifting this boat. That tells me the market views CYN's problems as idiosyncratic. They don't see it as a play on the AV boom, they see it as a broken financing vehicle. If the sector is hot and the stock is cold, that is a massive red flag. It suggests the market thinks they're going to miss the boat entirely.
I interpret that divergence differently. I see it as market inefficiency. The market is obsessed with the sexy, high-speed stuff, robot taxis doing 60 miles per hour on a highway. That is incredibly hard regulatory territory. The liability if a robotaxi hits a pedestrian is existential. CYN's tuggers drive 5 miles per hour in a private warehouse. If a tugger fails, it bumps a pallet of soda. If a robotaxi fails, it's a national news story. The regulatory path for CYN is clear and open right now. They don't need NHTSA approval to drive inside a private Pepsi facility. The market is bidding up the hard problem and ignoring the company that is actually solving the easy problem commercially today.
Solving the problem commercially is one thing, surviving financially is another. We have to talk about the mechanics of this upcoming reverse split on February 18th. A 1-for-150 split. That is a staggering ratio. It just screams of desperation to stay listed on the NASDAQ.
It is necessary for NASDAQ compliance. They have to keep the share price above $1. It's a mechanical fix to maintain access to institutional capital.
It's a mechanical fix that usually signals distress. But let's explain to the listeners why a reverse split of this magnitude is so dangerous. It's not just about changing the number of shares. When you change a CUSIP number, the ID number for the stock, which they will do on February 18th, it creates administrative friction. We often see a spike in fails to deliver or FTDs around these events. Back office systems at brokerages have to reconcile the old shares and the new shares. It creates a chaotic trading environment. And historically, short sellers view a reverse split as blood in the water. They know the price is artificially inflated to, say, $300 a share, and they will short it all the way back down because the fundamental burn rate hasn't changed.
But you're ignoring the liquidity buffer. The death spiral argument relies on the company being desperate for cash today, that they have to sell shares into the market immediately to make payroll.
Are they not? Their burn rate is significant.
No, they are not. As of Q3, they had about $35 million in total liquidity, cash plus short-term investments. Management guidance states explicitly that this runway extends through 2027. That is the key. They don't need to raise capital tomorrow. They have the cash buffer to let these 2025 orders turn into 2026 revenue. They have bought themselves time. The spiral happens when you must raise cash at any price. They don't have to right now. The dilution we saw over the last year was to build that war chest. Now they have it. The bleeding stops here, and the execution begins.
Through 2027 assumes they hit their targets and the burn rate doesn't accelerate. It assumes no surprises. But there is a detail in the split filing that I did find interesting. They are doing a shareholder-friendly move by rounding up fractional shares. So if you have one share, you get one share post-split rather than being cashed out.
Which is significant. It shows they are trying to protect the retail base. Usually in these splits, the small guys get forced out, cashed out at the lower price. Management is explicitly keeping them in the game. It's a gesture of good faith. It tells me they want their retail base to participate in the recovery.
And the liquidity in the stock, the dark pool dominance, the selling into news, suggests the truth is bearish. You can have the best technology in the world, but if the equity structure is toxic, the common shareholder gets wiped out while the company survives. I fear CYN and the company might succeed, but CYN and the stock will fail its current holders.
Then let's summarize where we stand, because we are looking at the same data and seeing two different futures. You see a trap, I see a springboard.
For me, CYN is a classic show-me story wrapped in a broken stock structure. You have 52% dark pool volume, double-digit short interest, and a chart that looks like a waterfall. The technology might be valid, but the equity is toxic. The impending reverse split on February 18th is a massive hurdle. History shows that stocks often sell off post-split as short sellers pile in again on the new, higher price. My view is extreme caution. Let the split happen, let the dust settle, and see if they can hold a price level. Until then, the smart money is betting against them.
And my perspective is that the market is driving looking in the rearview mirror. They are looking at the past dilution and ignoring the current inflection. The tripled orders news is not noise. It is the signal. The G&J Pepsi reorder is the proof of product market fit. We have a company with a $17 million market cap, fully funded through 2027, with a validated solution for a massive labor shortage problem. The valuation disconnect is extreme. If they execute on this order book, the re-rating could be violent to the upside. The risk-reward here is asymmetric in favor of the bulls.
If is doing a lot of heavy lifting there.
Investing is always about the if. But the data, the order data, says the if is becoming a when.
Well, we have a very specific date to test our theories. February 18th, 2026. That is when the split goes effective. That is when the new SISIP hits the market.
And that is when we will see if the technology can finally outrun the capital structure. We'll be watching. Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.